Happy 2023. We are back. It is the first Monday of 2023, and I'm here with another Monday Market Update. Hi, everyone. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona, and every Monday I'm here going over what's happening in the Phoenix real estate market and the national economy, really, because all of that plays in together. So let's jump in. I hope everybody had a great holiday and getting back to business now. So I want to start. Let's talk about some positive vibes as we are kicking off the new year. This article here we're looking at is saying homes could get more affordable even if prices don't come down. Now, really what they're talking about in this article mainly is interest rates. And here is what they're talking about. Homebuyer affordability could improve by 9% by the end of next year. This was written at the very end of 2022, so they're referencing 2023. So by the end of 2023, if mortgage rates continue to fall and home prices plateau as expected. Now, I know that's controversial. There are a lot of people that don't think home prices will be plateauing. They believe they'll be crashing. But in this scenario, what they're talking about is if home prices plateau, which seems to be somewhat reasonable based on what I'm seeing so far for this year. And we'll get into that in a little bit here, specifically for Phoenix. But they go on to say that they're mainly focused on mortgage rates here and the stagnation of home prices. They talk about how buying power has significantly changed between October of 2022 and October of 2021. So here they're saying at 325,000 in October, the average American's house buying power was down $162,000 from a year ago, despite 3.4% growth in household income to 73,951. So that's really all due to mortgage interest rates. That price got so unaffordable or changed so much, mainly because of rates. Of course, we did have home prices going up, but the biggest impact was what your monthly mortgage looks like due to that rate. So what they continue on to say here is, if the mortgage rates fall to about 6% by the end of 2023, which is what they're kind of predicting, or the industry is predicting as a whole. And I'm trying to find exactly where they say that in here. Here we go. If mortgage rates fall to 6% by the end of 2023, as the industry predicts, household incomes remain flat on an annual basis due to narrowing labor supply, demand gap, and slowing labor market, and nominal house prices decline by 0.3% annually, as the industry forecasts, then affordability as measured by the RHPI will improve by 9% by the end of next year compared with October of 2022. And the RHPI, they explain it up here. This is just kind of the way the First American Real House Price Index, how they're calculating buying power. But anyway, positive vibes, good news, right, guys? So the home prices could get, or your home buying power could get more affordable by the end of this year, even if we don't see a significant fall in home prices and home values. And why I like this scenario is because it is a positive thing for sellers and homeowners as well. Although I know a lot of people are rooting for a crash because they think things are unaffordable or they want to have an opportunity to buy. That also means that a lot of people who are sitting on equity right now, or planning to sell their home for retirement purposes, or consider their home as an asset as part of their wealth, all of that declines for them too. So that's not the prettiest situation for most people. So if we can have a win-win here, where we get back to an affordable range, where home buyers are still able to achieve their goal of home ownership, and we also have sellers that have maintained a solid home value, I think that would be a really nice place to be. So I'm starting off 2023 with these positive vibes, because why not? So that was one of the articles I wanted to share. And they also talk a little bit about a rate forecast. They think that rates for 30-year fixed loans peaked at 6.6% during the fourth quarter and could dip below 6% by the first quarter of next year. This is according to Fannie Mae, and then MBA economists are predicting an even sharper decline, rates falling to 5.2% by the end of next year, meaning this year, and averaging 4.4% during the second half of 2024. So overall, the prediction is that rates have peaked and we will only see those decline moving forward. I don't know if that is completely accurate. My guess is that we're still going to see some volatility in rates. I do think rates will go up a little bit as we start this year, but overall, I do think we'll start to see them come down. Hard to say for sure, but that's my little prediction. But I don't have as much certainty as they do in saying that rates have peaked. We could totally go back to those highs in the high sixes or hit 7 again, I think. So anyway, let's talk about some more good news. Monthly payments dropped $300 and some home buyers wade back in. This is a national article. However, this is something that we saw here in Phoenix in December as rates started to go down again because we've seen rates soften over the last month. We definitely saw some uptick in buyer demand. Again, that is reflected in what we're seeing in our Cromford market index, which I'm going to get into in a minute. But this is, again, a national article. So they're talking about how let me get down here. Where do we talk about this? The typical U.S. home sold for nearly $40,000 less during the 4 weeks ending December 18th than it did during the peak in June of $391,000. Average mortgage rates also dropped to 6.27%, taking about $300 off the typical homebuyer's monthly housing payment since rates peaked in late October at 7%. So $300 a month, I mean, that's a really good savings. So if the rates are going to go down that much and you've already been interested in buying, you're definitely going to get off the sidelines and jump in and see what you can find, especially in the fall when sellers are more interested in moving their homes if they've been on the market for a long time and knowing that you might be able to negotiate some concessions. So all of that makes a lot of sense that we started to see some more home buyers wading back in, as they say. Mortgage purchase applications also saw a substantial increase, with applications up 4.6% month over month. Redfin's Home Buyer Demand Index, which follows requests for Redfin's home tours and other home buying services, was up 6.5%. So overall, they're talking about, we saw in the mortgage world, more people putting in applications to buy a home, and then Redfin was seeing more activity based on the home buying activities that they track. Now, anecdotally, I also noticed that in our market with a little bit more activity, not only on listings that I have, but also from folks reaching out to me about starting the home buying process, or some that were on the sidelines and decided to maybe go have a few showings throughout December, which they weren't necessarily planning before. So we're not seeing this data reflected yet in sales because the sales cycle is long with real estate. It's usually about 30 days minimum from once we go under contract to closing. So we don't have closing data yet for December, but I do think we are going to see more homes under contract and more closings reflected in December as compared to November. And typically December is slower than November. So we'll see if that happens, but I do think we're going to have that data come out. So let's jump in and talk about our Phoenix market. Let's talk locally here. And real quick, if this information is helpful, hit that subscribe button and a thumbs up. I would love for you to be here with us every week. Sometimes I go live and I can answer questions for you too. And you can always reach out to me directly if you'd like. So if you're new here, let's talk about the Cromford Market Index. They are a publication that I follow that measures supply and demand factors in the market. They also look at everything going on in the MLS and provide all this data to their subscribers. And so this market index that they have is specifically looking at the balance of supply and demand and giving us an idea of where prices are headed. Because when you have more supply than demand, prices are going down. When you have more demand than supply, prices are going up. And so the way that you read this is that any number between 90 to 110 is considered a balanced market. Any number between 90 is a buyer's market, and above 110 is a seller's market. And you can see we are at 99.2, which is a pretty big change because it was just, I think like 2 weeks ago, we were like out of a balanced market. We were at like 89. We were at the very edge of a buyer's market, dipping into that area. And now we are strongly in this balanced market at 99 and climbing quickly, I might add. So we also have demand at 72.3 and supply is at 72.8. And why that's important is you can see those numbers are essentially the same, which is why we're balanced. Our supply and our demand is in the same place. So we're in this balanced market. That's what gives us the overall market index of about 100. Now, we have been seeing supply stay really stagnant, not adding to that, and it's been dwindling down very slowly. Not too surprising for the holiday season, but then we started to see that demand tick up. And over the last 8 months, demand has only gone down because of interest rates and affordability. And then, as I just talked about, as rates started to go down, we saw some buyers come back in, and supply did not get affected by that. Supply did not increase with the demand increase. Therefore, demand caught up a bit with supply, and here we are now into balance versus a buyer's market. Whether or not this will continue as we get back into the normal hustle and bustle of things, that's another question. I can't tell you for sure. My guess is that we are going to start to see more listings coming on the market. And with more listings, I don't know that we'll have the demand for those. And so we'll start to see some softening in this again. Just my guess. I don't know. I could be wrong. But that's kind of what I see coming up. Now, what is great about the Cromford Market Index is they break it down by the 17 biggest cities. And I know you all love to see this chart, but you may get blown away. So get ready because every city is green except for Goodyear. Goodyear didn't want to participate. But we've got a green arrow for every single major city throughout Phoenix. And I don't remember the last time we saw this. And so what this means is that all of those cities with a green arrow means that they improved for sellers, for homeowners. You got more leverage because there are fewer homes for sale and there are more buyers looking. And so you kind of inched up as a seller, as a homeowner. You have more leverage. Now, keep in mind, the same thing still applies. So any number under 90 is a buyer's market. So everything from Avondale down to Buckeye is still in a buyer's market. Although they made progress towards being more advantageous for a seller over the last month, they are still in a buyer's market. Now, there's a pretty big change because over the last month, we've been seeing, or I think throughout most of November into December, we were seeing the average change in the CMI falling every week by about 4.3%. And this last month, when we look at the change month over month, we actually saw an increase of 16.3%. That is a huge difference in how the market has reacted or how the market has changed with buyers and sellers, supply and demand difference. So an improvement of 16.3% on average. You can see with all of these here, Paradise Valley is obviously the most impacted here with a 43% change positive. So they made a pretty big difference month over month. We've got Cave Creek at 17%, Tempe at 25%, Avondale at 35%. And you can see Goodyear is still negative. So they deteriorated for sellers, for lack of a better explanation there, by 5% when you compare month over month. So that's essentially what all of these are saying. Their CMI last month was 71. Their CMI this month is 67. So that's how we're looking at this. And so a pretty big difference in what has happened over the last month. And again, a lot of this is due to a lack of supply that we have. And we just saw enough uptick in demand to start taking some of those listings off the market and they weren't getting replenished. So the question is, what's next? Is this going to continue as we get into 2023, or is this just the seasonal situation that happened with our weird market coming out of the craziness into the slowdown, and then rates fluctuated enough to get people back out there slightly during a time that's usually quiet. I don't know. I imagine, like I said, we'll see a lot of sellers join the market in January. That's typically what we see, but I don't know if it's going to be enough to outpace the demand, or if our demand comes back because buyers are like, it's a new year, new home, new me, and I'm cool with these rates because I've come to terms with the fact that this is where we're at today. So, is a seller's market back? I don't know. Are we going into a seller's market? Maybe. I don't know. It's 2023. We will see what happens. But you guys, that's all I have for today. So I hope that information is helpful. If I can answer any questions for you, reach out to me directly. All my info is in the description below, and I also have some links for your home value and to search my MLS. So make sure you take advantage of that. And I appreciate you being here. I will see you next week for another market update, and send me any questions that you have along the way. Have a great week and Happy New Year, everyone.